Welcome back. Take a look at where markets ended the week and a great month of November. Take a look at stocks for the month. The Dow closing at the highest level since January of last year. The S&P 500 and the Nasdaq seeing their best month since October of last year. But does that rally continue into December and into the new year? Joining me right now is the founder of Satori Fund. Dan Niles is with us. And during November, Satori had its best month in over 2 years. Dan, always a pleasure. Thanks for joining us this weekend.
My pleasure as always, Maria.
I know that you have some questions about the year ahead, certainly as it relates to the macro story and the stock market after this huge outsized move for November and all this year. Do you think this rally extends into the new year?
I think it extends into the new year, but I think it's on a time clock. And I've called it Goldilocks meets the three bears, because I think right now everybody's assuming a soft landing. They're assuming that the Fed is going to cut in the first quarter of next year. And I just don't think that's going to happen. I think inflation is going to stay a little bit higher than the Fed wants for longer, and that there's not going to be any rate cuts anytime soon. And I think that the delay of the Fed raising rates will slow the economy down next year as well. So I think, yes, do we get a rally through year end like we normally do? That's just normal seasonality, absolutely. But I think after that, you could have some real turbulence in Q1.
Yeah, and you're not alone in that thinking. You said Goldilocks meets the three bears. One of those three bears that you're referring to is the consumer, that you say is tapped out. And this week we saw JP Morgan CEO Jamie Dimon warn of a similar issue. He says we could see a looming recession. A lot of things out there are dangerous and inflationary, the CEO said. Be prepared. Interest rates may go up, and that might lead to recession. He's been talking about this so-called economic hurricane, though, for a long time, Dan, and so far we haven't seen it. Are you surprised that we have not seen a bigger impact from these 11 rate hikes from the Federal Reserve by now?
Yeah, I mean, I think actually I'm not, as I had more time to think about it. Earlier in the year I was, but if you think about what's happened, we had about $2.5 trillion in excess savings from all the stimulus checks that went out. And so now that's getting depleted. And that's going to be basically back near zero by the time we exit this year. In addition, you had 25 million people not having to pay back student loans for about over 3 years. That restarted in October. And don't forget, monetary policy acts with a lag. And so it takes some time from the rate hikes for that to work its way through. So you put all of those things together, and I think that's why it's taken a while for the slowdown to occur. And don't forget, unemployment's still really low. It's below 4%. And as long as there's a lot more job openings than people unemployed, that's also going to delay any slowdown. So that's why I think it's been delayed so long. But I make no mistake, I think we're going to get one. I think it's going to be shallow, but it's still not something I think people are prepared for with valuations where they are.
Yeah, especially since we're seeing this, consensus of, yes, the Federal Reserve is going to start cutting interest rates. I wonder how you see the Fed cutting rates versus Europe, because I'm being told that the Eurozone is in worse shape than the United States is right now, and that the ECB is probably going to cut rates before the Fed cuts rates.
And that's completely true, because Europe's got a lot more issues. I mean, don't forget, we're insulated from it here, but there's a land war going on very close to where the Europeans are, right, between Russia and the Ukraine. Yeah. And their economic picture is in much worse shape than ours is. So I think you're going to see a lot more estimate cuts in Europe, as well as the slowdown that you're rightly talking about. And so I do think the ECB probably ends up cutting. But don't forget, slowdowns in Europe, they're going to affect us economically. And all of the world's interconnected, and this will eventually show up on U.S. shores.
All right, so let's talk about how to allocate capital. Having said all of that, Dan, I know that you've got this barbell strategy with tech, and I want to get your take on that, because obviously the quote-unquote Magnificent Seven, the 7 technology stocks that have led this market, are really where the moves are. You've got a strategy on that, and you're also looking at good valuations in certain areas like small caps and biotech. You think that they're trading at good levels. How do you want to allocate capital for 2024?
Well, number one, you want to make sure you have a lot of good shorts on, and so we do. I mean, we had our shorts less than 1% of assets back on October 26th, expecting this kind of rally. Our shorts are now back up to about 50% of our assets. But in terms of the longs that we have, we still like two of the Magnificent Seven. We like Amazon, which we think has the most profit margin leverage of all of them. They beat operating profits by 40%. Obviously, the fourth quarter is a big quarter for them with the holidays. And we also like Meta, which we think has the best combination of growth at 15% revenue growth and valuation at a 23 PE. Don't forget the S&P is at about 4% revenue growth, a 21 PE for comparison. But the other side is we're looking for really unloved names that people hate, where we think there's a turnaround in the fundamentals. So in the semiconductor space, where you've had some inventory corrections, we're looking at the biotech sector as well. And we're also nibbling at the solar sector, which we're thinking is getting close to the bottom. And so that's our barbell of sticking with a couple of the loved names in the Magnificent Seven and then looking at unloved names, especially in the small cap area.
I love it. And obviously your strategy keeps on working real well. Dan, it's good to see you. Thanks so much.
My pleasure, Maria.
All right, Dan Niles from Satori